Four stocks I'm buying now, March 2025 edition. Welcome in, folks. My favorite video I do for you guys each and every month. We're about to go into the best investment opportunities I see in the stock market right now. And as you know, if you follow my channel closely, I always put my money where my mouth is. I don't just say, oh, this stock's a buy, that stock's a buy. No, I come with the money behind it, right? And so this is always my favorite video I do for you guys each and every month, right? Three things before we get into today's video, okay? 90% of the people that are going to watch this video, you guys follow me, you watch me on this channel, probably my reaction channel. I appreciate y'all for being here as always. But for the 10% of people that don't usually watch my videos, understand I'm a long-term investor. I'm going after the loaves of bread. I'm not going after the breadcrumbs. I'm anti-breadcrumbs. Okay, breadcrumbs mean trying to make a small amount of money on a stock and then run out of it. I'm investing for the long term, usually for years. And I'm going after a stock to make tens of thousands, hundreds of thousands, or millions of dollars. I don't ever buy a stock unless I'm planning on making at least multi-five figures, if not six figures or seven figures. It's not worth my time investing in anything that would be smaller than that, essentially. Second thing to understand is I have a GVD 1-2-3 strategy. That's where I buy growth stocks, value stocks, and dividend stocks to build out a phenomenal all-around portfolio. It's 1-2-3, meaning essentially the most money will be allocated in the best risk reward. Then I'll invest a little smaller in the second opportunity, a little smaller in the third opportunity, right? And my whole strategy always is survive the bear markets and thrive in the bull markets. And that's exactly what we do time and time again. I've been doing this for over 16 years now at this point in time. Always a lot of fun, okay? One thing only I need from you guys is for you to smash that thumbs up button down there. Hit the like button on this video. I hope you guys can do that for me. I started prepping this yesterday, prepped it last night for you guys, and all I need from you guys is to hit that like button, okay? Additionally, if you want to subscribe to the channel, you can certainly subscribe, as the sign says in my garage there. We're now over, gosh, how many subscribers do we have? 830,000 plus. I appreciate y'all for being here, okay? Additionally, if you're looking to take your knowledge up to a much higher level, join an exclusive group of investors that have six figures, seven figures, eight figures in those portfolios, click the pin comment down there, fill out a form. We'll see if we can get you access to my private stock group, my private wealth group, as well as my software, which is called 1000xstocks.com. That's what I use to analyze stocks on a daily basis, okay? So many people have been able to go through my program and then scale to six figures, multi-six figures, seven figures, multi-seven figures, and even eight figures. And so if you're looking to scale up, take things much more serious in what you're taking it, pin comment, fill out a form, see if we can get you access to all that. And then once you hit six figures and seven figures, we got our six-figure award I send out to you, and then seven-figure award I send to your house as well. And you also get your Steel membership cards in the mail, okay? Alrighty, guys, busy video here. Let's get into this. First stock of these four stocks up here is Elf Beauty. Wow, what an investment opportunity this one is. $63 stock here today, okay? First one of these four stocks. This is the best opportunity to buy Elf stock in years. I mean, literally in years. Absolutely amazing time to be a buyer of Elf stock in 2025. The crazy part about Elf right now is the whole company is trading for a $3.5 billion market cap. And considering how much scale this company now has, their distribution points, how big the brand is now, for the entire company, how strong their financial statements are, for the entire company to be only trading at a $3.5 billion market cap is, in my opinion, very, very crazy. The company is very undervalued at this point in time, and they're on their way to becoming a cosmetics and beauty giant. Not a small little company anymore. They're on their way to becoming a $10 billion, multi-$10 billion company down the road, okay? Now, everybody's freaking out over this stock. Why is the stock crashed? Well, everybody's freaking out about this one because tariffs. So if you look from essentially the time Trump started taking the lead in regards to election, Elf stock started falling. And then when Trump won the election, Elf stock started falling even more. And then once Trump got into office and announced tariffs, Elf stock fell even more. And the reason being is we know Trump does tariffs, right? And a lot of Elf's products come from China and come from Asia in general. So this creates this dilemma where people are all scared about Elf's going to get hit with these tariffs, right? They're going to have to pay these tariffs, and therefore Elf's margins are going to sink massively. Therefore, Elf's, going to have to go up on price if they don't take a margin hit, and therefore all their customers are going to go bye-bye. What people fail to understand in regards to Elf, if they just did a little more digging in regards to this company, is Elf's products are extremely affordable. Like their products are like $12, $8, $9, $5, $11, okay? So even if Elf has to pay tariffs on that, they're going to be able to offset that many various ways, but one is they can go up on price with their customer base, and it's not hard to do. And remember, they're paying the tariff not on the sale price of what they sell on Amazon. They're paying a tariff on what the actual import price is, which is much lower than where they're at right here. So Elf might go up 25 cents on a product, 50 cents on a product, $1 on a product. And do you think all their customer base is going to be like, oh, I can't afford to buy my Halo Glow liquid filler now? Come on. Are you kidding me? Okay. Oh gosh, I can't afford my Power Grip primer now because it went up 50 cents. No, that's not the way this works. Okay. So the moral of the story is this tariff situation's here today, gone tomorrow. It is what it is. And Elf's already gone through tariffs before. This is not the first rodeo in regards to Elf being hit with tariffs, right? And let me show you this because I think it's very important for everybody watching this right now to understand this. When I bought Elf stock, that was back in 2019, right? Early 2019. This was during a time period of the Trump tariffs. Elf growth rates were getting hit. People were worried about their margins, and the stock was $7 a share. I bought 1,000 shares right here at $7.28, and I continue to load Elf after that over the next few months, and I made a lot of money on Elf. It was insane. But the moral of the story is it's gone through this whole crap before, right? As it did back in the end of 2018 and the beginning of 2019. It was so anti-China, anti-trade. It's a trade war. It's this and that, tariffs. At the end of the day, Elf made it through just fine and out to the other side, right? And by the way, then Elf had another crash actually in 2020 because suddenly everybody's going to be forced to be home. So people thought no one's going to buy cosmetics anymore, beauty-related products. And Elf stock crashed and came right back. Elf is a very durable company. Recessions, inflation, deflation, tariffs, no tariff, blah, blah, blah. Elf makes it through to the other side, gets stronger. Remember, I tell you guys, survive the bear markets, thrive in the bull markets. And that's exactly what Elf does with their business model time and time again. Now, what you're looking at in front of you right now, this is 1000xstocks.com. This is our charts feature. This is Elf's revenue over time. Now, this is the factual part, right? That's what's happened with their revenue. Now, this is the opinion part. We're looking out to the future and kind of what analysts are expecting in 25, 26 for this company, right? And so analysts have gotten very bearish in regards to Elf's numbers over the next year to year and a half, right? And we'll see. My guess is Elf's going to continue to grow their business. They're going to continue to put up very strong numbers, and everything's going to be just fine. And we're going to see an earnings per share that's going to actually increase dramatically over the next few years, right? Additionally, look at Elf's stockholder equity. It's higher than it's ever been. Their balance sheet's in a phenomenal spot. So here we are. We got a growing company that's been growing massively. They're now growing around the globe. The very important thing I mentioned here, and I didn't prep a slide for this, but I have to mention this. Elf is so successful in social media, Instagram, TikTok, YouTube, whatever you want to say, okay? That since they're so famous on social media, when they go to a new market, people in a new market already are very acquainted with Elf's products, with the brand, all those sorts of things before they even go to a market. So basically, Elf can go to a new country, launch their products, get distribution, and start selling pretty well from day one because people have already seen it on their social medias. It's amazing, okay? So I just thought that was worth mentioning there. I didn't prep a slide for it, but it was worth mentioning, okay? So let me take you through my bull case, my base case, and my bear case for Elf over the next, we can call it 4 years or so, okay? Here's what we're looking at. So my bull case for Elf, this is our projections feature on 1000xstocks.com, where you can, plug in numbers, adjust growth rates, and understand where stock price is going to go over time, okay? My bull case for Elf, I have them doing 20% revenue growth on average per year for the next 4 years. I think that's very doable for the company, given not only their domestic opportunity, but additionally that international opportunity. Oh my gosh, okay? So revenue growth, I have them doing about 20% revenue growth per year on average for the next number of years, which should put them, we can call it $2.7 billion or so in revenue in 2028. Net income growth should be far faster because they've been really just focused on revenue growth the last few years. And so what you should likely see is a lot more focus on the bottom line, net income growth. So I've been doing 40% per year over the next 4 years. That puts them at $377 million in net income come 2028, which puts them at a net income margin of 14%. That's not a high number, okay? Elf long-term probably can get to net margins closer to 20%. So 14% is still like early days net margins for the company overall. It's going to be a big improvement over the next, basically over this 5-year span, but it's not like this is a unheard of crazy number. No, they have a long way to go after that still. Now, PE for a company that's growing 20% top line, 40% bottom line, that's cosmetics, and has that stable business model, you're talking about easily a 30 to 40 PE. And I'm probably being conservative in regards to 30 to 40 PE, however. So that puts the stock somewhere between about $204 and $272 come 2028, which gives me a compound annual growth rate of 34% on the low end, 44% on the high end. What's my base case? Base case is just a fancy way of saying what I, actually expect for the company with a little bit of conservatism in there, okay? Revenue growth of 15% per year puts them at just under $2.3 billion of revenue come 2028. Net income growth of 35% per year on average. That puts them at $326 million in net income come 2028. Easily a 25 to 35 PE is fair for a company that's growing top line 15%, bottom line 35%. I'm being low on my PE projections here. That's low. For a company in this industry growing like that, low, okay? But that puts the stock somewhere around 150 to maybe just over 200, which means a compound annual growth rate on the low end of 23%, high end of 34%. Now, my bear case, the best case about whenever I run a bear case, if I can still make money even in my bear case, that's really good news. And that's exactly what we see here in regards to ELF in my bear case, okay? Revenue growth in my bear case, only 10%. This would be a disaster for ELF. If they only grew revenue 10% per year over the next 4 years, bad. Net income growth on average of 20% per year, which once again, that would be bad. That would put them at only net income margins of only 11% come 2028, bad. Okay. PE, 20 to 30, very fair for a company growing top line 10%, bottom line 20%. That puts the stock somewhere between $73 and $110. Gives me a compound annual growth rate of 4% on the low end, 15% on the high end. So even in my bear case, I still make money on ELF. It's a pretty dang good opportunity, all right? And that's why the moral of the story is in regards to ELF Beauty. You buy and you buy and you buy this stock. 2025 is the best year to be a buyer of ELF stock I've seen, honestly, since probably like 2019 when I was first buying this stock. Because when I think about the risk reward, when I think about where the business model is now, where the business model is headed over the next few years, man, this is just a very attractive stock. And so this is one that, if you buy it at 63, hope it goes down more so you can buy even more shares next week, next month, and the week after, right? And you get shares at 53. But don't count on it. Everybody gets very greedy. There's two markets where people get very greedy. The first market is when stocks are going up so much, they get greedy and they think they never have to sell. And it's just like, they just keep holding and buying and margining out. That's a greedy market. And that's people getting greedy. The other place people get greedy is when you're in a downtrend, a significant downtrend for stock. People will see a stock down 70% and they're not satisfied. They're like, no, I want to get it even a bigger discount. I want it down 80%. And then they miss that opportunity. And then they think it's going to go back down. Then they miss it more. And then they think it's going to go back down. They miss it more and more and more and more. And next thing you know, the stock is freaking, $200 again. And people are like, wait a minute, I could have bought at 63, but I was really hoping for 43. And so I just missed out on it going to 200, right? And then you look back and you're like, why? Why would I do that, right? That's what happens. So moral of the story, buy. Next stock up here, AMD, Advanced Micro Devices. Now, some people have been calling this one Advanced Money Destroyer, Advanced Money Disintegrator, Decimator. I call it Advanced Money Doubler, okay? AMD has insane upside, and it's going to be a whole lot more than a double, in my opinion, in regards to stock, okay? $98 stock here today. Now, AMD, okay? You got to understand, this is very important, everybody understands this. We're at inning 1 right now of a new growth cycle for AMD. So AMD's business model can go through some incredible basically cycles where the growth is just unbelievable for AMD. And then it can go through some very vicious cycles where the company has trouble growing at all. Now, the company just went through that over the past few years where the business model hardly grew or actually didn't even grow for quite a while, right? But we've reached a new game. The new game has started for AMD, and we're in inning 1, and they just have started. This is their latest quarter, trailing 12-month revenue here. This was a previous trailing 12-month. We just entered inning 1 of a new growth cycle for AMD. And inning 2's about to start here, and it's going to be a whole lot of fun. We're going to see some insane growth rates in inning 2 and inning 3 for this company, which is 2025 and 2026. And we're going to go over that in just a moment here, right? Now, when it comes to inning two and inning three, it's really going to be a blast, not just from the revenue growth opportunity and the revenue growth you're going to see for the company in 2025 and 2026 and 2027, but really from the bottom line perspective, the rate of growth you got to understand in the earnings per share of this company is going to far outstrip the revenue, and it's not even going to be close. So much of every new dollar coming in for AMD is going to be hitting that bottom line versus before. So you're going to see gross margins. We've already started to see gross margins pick up, right? But the growth in gross margins and net margins, bottom line margins, is going to be intense over this next several years in regards to AMD. Now, MI350 is massive for this company, and this is the start. This is what I call inning two. Inning two starts when MI350 goes into production, which is mid this year. You could take mid as June, July. Okay, we're going to start getting into big production. And then the big dog's coming, MI400, in 2026. So we have a lot to be excited about here. Okay, the customer feedback, this is from the latest conference call, Lisa Su. Customer feedback on MI350, which once again, that's the one that's about to launch and ramp in mass here over the next few months, has been strong, driving deeper and broader customer engagements with both existing and new hyperscale customers in preparation for at-scale MI350 deployments. Based on early silicon progress and the strong customer interest in MI350 series, we now plan to sample lead customers this quarter, basically talking about the quarter we're in right now, and on track to accelerate production shipments to mid-year. That's phenomenal. This is indeed interesting given that AMD's MI350 will be based upon a 3 nanometer process node, which will offer up to 288 gigabytes of high bandwidth memory and can be a direct competitor to NVIDIA's Blackwell lineup. To top it off, MI350 is said to feature AMD's next-gen CDNA4 architecture, which will show us how far AMD has come along in terms of generational gaps between its AI architectures, likely giving us a better rundown of the future. So MI350 is a huge step in the right direction for AMD. It puts them much more in a great competitive spot to compete with NVIDIA over this next few years, right? And then MI400 is going to blow the doors off. That's a whole other level up there, right? Now, additionally, this company announced back last year that they're going to buy out a company named ZT Systems for $4.9 billion, okay? This deal should close, honestly, in the first half of this year, so it should honestly close in the next few months. And ZT Systems is a company that designs and builds server equipment, particularly AI infrastructure for large computing companies. AMD's acquisition of ZT Systems is intended to help AMD compete against NVIDIA in the AI market. Because you got to understand, NVIDIA's got the whole stack. They got the chips, they got the software, they got everything. AMD is now going to have everything. They're going to have the whole infrastructure, they're going to have the chips, right? They're going to have the software. So people got to understand that AMD is now getting themselves in a great competitive position to compete with NVIDIA in 2025 and especially 2026 and 2027. This does not mean AMD is going to knock out NVIDIA or anything like that. It's just like they're going to have some incredible growth rates because AMD is likely, in my opinion, going to undercut price on NVIDIA. And so if you're looking for, what some people will view as just as good of chips, and remember, like, all these big tech companies don't want NVIDIA to get too powerful in this space because if NVIDIA gets too powerful, they continue to just command insane margins. So everybody in big tech is rooting for AMD. And that's something I don't think a lot of people really understand if they're not like really, really into this sort of stuff. Microsoft is rooting for AMD. Meta's rooting for AMD. Amazon's rooting for AMD. Google's rooting for AMD. Everybody wants AMD to have phenomenal chips, phenomenal software, phenomenal stack, because at the end of the day, that keeps NVIDIA from charging ridiculous prices. NVIDIA has been able to command insane prices for their AI chips in 2023 and 2024. Why? Because they had no competition. If you have no competition and everybody needs your product, you can charge whatever you want. If NVIDIA says it's going to be $50,000 for this chip, pay it. Pay it. You have no competition. And so the beautiful thing is, for a lot of the big tech companies now, AMD's finally got themselves in a position to start really actually competing against NVIDIA this year, and then even more so in 2026 and 2027. And so, the whole industry is rooting for them, other than maybe NVIDIA, right? Now, the additional thing you got to understand, right, is AMD's a little over $150 billion market cap right now. This company, in my opinion, based upon the growth rates I have for this company over the next number of years, they're on the way to becoming $1 trillion market cap over the next 3 to 5 years. Now, I don't have this company becoming an nvidia. I don't have them getting to a $3 trillion plus market cap like nvidia got to, right? I don't think they need to do that. You got to understand, like, for this to be an incredibly successful investment, if AMD just gets to $1 trillion over the next 5 years, I'm looking really good. I'm looking really good, and everybody that bought AMD stock is going to be looking really good in the end. That's all we need. We don't need it to be like if AMD ever becomes a company the size of NVIDIA and it's a $3 trillion market cap, right? Great, but I don't expect that, and I don't think that's going to happen, and I don't need that to happen. But I do, based upon my numbers over the next 5 years, I do see them getting to the $1 trillion market cap in the next 5 years. So pretty incredible opportunity. The moral of the story is in regards to AMD, you buy this stock in 2025 and you don't stop buying and you just keep buying. And that's exactly what I'm doing. Almost every single week right now, I'm buying AMD shares. Today, I bought more AMD shares. Today, literally. And I'm not done buying. And so, I'm trying to gobble up as many shares as possible. I want to gobble up as many shares as I can before MI350 gets scaled out. That's a moral story. Because once my opinion is, once MI350 is really starting to get scaled out in production, there's no getting the stock at $98 anymore at that point in time. There's no getting it for under $100. Like, that's boat's going to be long gone, okay? Alrighty, guys, next stock of these bunch, 3 of these 4, is Celsius Holdings, an energy drink company. $25 stock here today. Ticker symbol on this one is CELH. Now, the important thing you got to understand about Chick-fil-A, gotta love some Chick-fil-A, about Celsius is in 2024, people were lining up to buy the stock as it approached $100 a share, right? They were in a big line. And now here we are, $25 the very next year. Celsius is $25, and where are the buyers at, right? So you got to understand what happened here, why Celsius went to $100 a share, why everybody was trampling over themselves to buy this stock, and why you can't find anybody to buy this stock right now, okay? And why I really understand that this is a tremendous opportunity here. So the long story short here is, in regards to Celsius, is Celsius was a $30-something stock, okay? Then Pepsi announced that they were going to buy a minority stake in Celsius, and it was for a massive distribution deal. And so Pepsi owned a little less than 10% of the company. Now, Pepsi then went and distributed this company's products everywhere it could. Additionally, they ordered too much dang inventory, okay? And so what ended up happening was, after the deal went through, Celsius gets them distributed everywhere, and they order too much inventory. Celsius growth rates looked too high, which caused everybody to flood into the stock at $80, $90, $100 a share. And then there was a come down of that, right? Where Pepsi's had a normalized inventory now at this point in time, which is a painful situation to go through. That situation's about done now. But it was very painful to go through. The numbers have been very disappointing out of Celsius because Pepsi had to work through a lot of inventory and lean up their inventory levels. They went too crazy with their buying, okay? So that's what happened, and it's important everybody understands this in regards to the company. The company didn't break. It's just the company should have never put up as strong a growth rates as they did, which got everybody super hyped on the company. And then there's a come down of that. And so today, think about this. Today, I get the stock cheaper than before the Pepsi deal. Think about that for a moment. Before the Pepsi deal, the stock was a $30-something stock. Today's $25. Let that sink in for a moment, right? Now, the company has been a growth beast over the last number of years. Like Celsius, no one heard of Celsius 5-6 years ago. And now, Celsius is in every major food store, pretty much you can imagine, Walmart, Target, all the stores. It's super popular in the fitness community, very popular products, right? And the growth rates have been extraordinary for this company. But we're in the pain cycle for Celsius right now. And that pain cycle is about to wrap up here, but we're in it, okay? Now, we're about to go through another beast cycle starting at the end of this year, okay? We're going to have another beast growth cycle for Celsius that's going to start at, basically, think of it as the second half of this year. So basically, in the summertime and after, we're going to start having another beast growth cycle that's going to carry us into 2026 and 2027. Now, You might say, okay, why not wait until the second half of the year to start buying Celsius stock? By that time, Celsius could be $40 a share. Like, I wouldn't be surprised if by the time we get to the back half of the year, Celsius is 40. Like, I would love it to continue to be 25. I would love it to continue to be whatever price, like $22, $19. But I highly doubt Celsius is down here at these sorts of prices by the back half of this year. I wouldn't be surprised if by then it's $40 plus stock. So the moral of the story is I gotta add my shares now, right? Next up, to get you caught up on the situation, Celsius bought a company named Alani Nutrition, a $1.8 billion deal. That deal obviously has to get approved, and it should get approved, not in too distant in the future here. But this is a very female-heavy brand, this Alani brand. Very, very female-heavy demographic. Like, from what I heard on the conference call, we're talking like 90%-ish female, right? Which is interesting because the energy drink category has always been heavy marketed to males, right? And always been, like, if you're thinking about, I worked at Quick Trip for a long time. I worked at Walgreens, and we sold a lot of energy drinks, and we sold a lot at Quick Trip especially, okay, at QT. When I worked at QT back in the day, you know who bought energy drinks? Landscapers, construction workers, dudes bought energy drinks, and they bought Monsters and they bought Red Bulls, but they bought a lot more Monsters than Red Bulls, by the way. That's who bought it. It wasn't like, the lady going to the office who's the accountant coming in and buying a Monster. That wasn't the way it worked. But now these products have really been marketed to female demographic, and Celsius is actually pretty successful in female demographic as well. But this Alani is like a whole different ball game, okay? Now, additionally, this brand also sells protein bars. They also sell some, snack-related products and things like that. So we'll see how Celsius wants to take that business. Do they want to expand into more protein bars and energy bars and things like that? Or are they okay just sticking with drinks? I don't know. We'll see. That's just another potential for the company here, okay? Now, next up, to get you caught up on the story, and this is pretty new news, is Celsius names PepsiCo's Eric Hansen the company's president and chief operating officer. He's going to start effective March 21st, an extremely important position for the company. And basically, this gentleman's being brought in. He's 53 years old, so prime of his career, right? He's being brought in from PepsiCo. He was at Pepsi since 1997, most recently as Senior Vice President of Strategic Partnerships. And so now that Celsius is doing this deal, it seems like a great time to bring in a gentleman like this as President and Chief Operating Officer. If you don't know, Pepsi owns so many brands, it's ridiculous. And so this gentleman had a pretty important role there. Now, what's interesting about this is Celsius said Hansen will receive an annual base salary of $700,000, which is not that much money. I'm thinking, for this sort of role at this sort of company, that's kind of a steal. My guess is he's going to get some crazy stock options, and he's probably going to make millions or tens of millions of dollars on his stock options over the next few years. That's my guess, because I also believe Celsius stock's going to increase massively in value over the next 2, 3, 4 years. And so this gentleman's probably going to end up making himself millions or tens of millions of dollars over the next 3 or 5 years working at Celsius. But I mean, the base salary of only $700,000, I'm just saying, for this role, it's not much money at all. So really good find for Celsius there. And obviously Pepsi owns a significant amount of the company. So, I think Pepsi will be happy with this as well, right? Now, let's just think about this practically before we, you can get caught up in the PE ratios and the price to sales ratios and all that stuff, right? At the end of the day, just think of this practically. Celsius. The stock was $30 plus in 2022. It's $25 right now, okay? Since 2022, the revenues of the company have gone up dramatically. They have now Pepsi distribution wherever they need Pepsi distribution. They have bought out a company named Alani, right? That the deal should get approved very shortly here. And that's an incredibly fast-growing brand, right? And now they have a Pepsi veteran since 1997 to come in and be the COO of the company, Chief Operating Officer, which is, but once again, that's an extremely important role. I would call it the second most important role at the company overall. Some would say it's actually the most important role at the company. So I like what I see here. I like what I see in regards to Celsius. I think we're looking really, really good here, right? Now, if somebody's scared about just buying Celsius shares, you can always do what I do and hedge with Monster, right? That's what I've done. I've hedged with Monster. It's going very well. So just in case I'm wrong with Celsius, I got Monster as a hedge. Once I'm convinced I'm not wrong on Celsius, right? 100% convinced, back half of this year, they start growing very nicely again, everything's good. I'll probably sell off my Monster and move on from that position. But for now, it's just there as a hedge, just in case Celsius brand fails or something in the next, 6 months, 12 months. Like the biggest beneficiary of that would be Monster, since they own Monster brand, Bang Energy, and Rain Energy as well. Okay. So moral of the story is, in regards to Celsius, buy. Now, I got a little treat for you guys here today. Okay. Before we get into the fourth stock, I'm going to share two very cheap stocks that are incredible opportunities in my opinion. Some would call these spec stocks. Here they are. One is Honest Company, HNST, before we get into number 4. This is one of the two spec stocks I would mention. But Honest, it's a $5 stock, but honestly, this company, no pun intended, it's not even very speculative. Here's the deal. The company, based upon the income statement, they should get to massive profitability actually in 2025. So it's hard to call a company speculative when they sell all needs-based items, soaps and lotions and diapers and wipes and all that stuff. And they're likely going to be extremely profitable now in 2025 and moving forward, right? It's hard to call them speculative. Additionally, it gets even more hard to call them speculative when the company has more in cash and cash equivalents than they do in total liabilities. That's mind-boggling. They have $75 million in cash and cash equivalents. And they have $73 million in total liabilities. That's insane. Absolutely insane. So Honest, phenomenal. Next one up here, these spec stocks, is Fubo TV, a $2.84 stock here today. Listen, in regards to Fubo, it's all coming down to the deal that is expected to go through between them and Disney, right? Hulu plus live TV. This should hopefully close in the second quarter or third quarter of this year. And this is going to be a huge transaction, obviously talking about 6 million plus North American subscribers. And this is going to position Fubo into being a giant and get them into a great relationship with Disney, which you got to have a great relationship with Disney if you're going to be in this sort of business, okay? Additionally, people forget about all the money Fubo is going to have coming in. In connection with this deal, at signing the transaction, Disney, Fox, and Warner Brothers will make an aggregate cash payment to Fubo of $220 million. In addition, Disney has committed to provide a $145 million term loan to Fubo in 2026 as part of the transaction. My gosh. And additionally, a termination fee of $130 million will be payable to Fubo under certain circumstances, including the transaction fails to close due to regulatory reasons or whatever. Then they would still get paid out $130 million. So Fubo's about to get a multi-nine-figure payday and be in a great spot. Like, are you flipping my flapjacks? Like, this is just, once again, a pretty insane opportunity. I think we'll look back at the stock being $2.84 and be like, that was silly, right? Once a deal goes through, I wouldn't be surprised if the stock at this time next year is like $10 this year. I wouldn't be surprised, right? It's $2.84 right now. Come on, man. Crazy, okay? Next one up here, stock number 4 of these 4 stocks is Cheesecake Factory, a growing giant. $51 stock right now. Oh my gosh, do I love this stock. I'm gobbling up as many shares as I possibly can of this one, okay? Now, what I'm showing you in front of you right now, very important. That is the largest market cap restaurant chains out there. Now, should not come as no surprise when you look at the top of that list. You see names like McDonald's. You see names like Chipotle, right? They didn't put Starbucks on this list for whatever reason, but Starbucks would certainly be up there, right? Those ones should come as no surprise. But I'm in full belief, and by the way, Cheesecake's about a $2 billion market cap right now, or a little over $2 billion. I'm in full belief that if we look at this list 10 years from now, Cake will be a top 10 biggest company. And the reason they're going to be top 10 biggest companies has nothing to do with their actual Cheesecake Factory restaurant. That's their cash cow that makes them a ton of money, and that's going to allow them these growth opportunities. But it actually has basically nothing to do with the actual Cheesecake Factory restaurant. It has much more to do with other opportunities. This is a minor reason. It's called North Italia. North Italia now has 43 locations, and they're on their way to having 200 locations. And I wouldn't be surprised if they could do more than 200 locations long term. This is an extremely, I think there's going to be a big hole in the marketplace when it comes to a national chain of Italian food. Because I believe Olive Garden is actually going to get into a lot of problems over this next 10 to 15 years. Olive Garden was really positioned well for the last 20, 30 years in America, right? The problem is Olive Garden's Quality is not very good. And the other problem I see with Olive Garden is their restaurants have gotten extremely dated now at this point in time. And so when you have food quality that's not very good, right? And people are expecting better and better quality over time when it comes to their food, Olive Garden's not going to probably make the changes necessary to get up to a higher standard of food like they really need to for the newer generation. So Olive Garden, in my opinion, will slowly fall off, and they're not going to have the money to reinvest into their restaurants to make them more modern and look nicer and give a better ambiance. So I don't see them investing into their food, and I don't see them investing into their restaurants. And so basically, I think Olive Garden's going to become less and less relevant. Let's just call it over the next 10 or 15 years, essentially, which creates a massive opportunity in the marketplace for something much higher end, much better food quality, right? And the type of restaurants you actually would like to take a date to, and that's North Italia, right? And so that's minor reason. This is a major reason, though. It's a brand called Flower Child. They only have 38 locations of these so far. They believe they're going to grow to 700 domestic locations, and I have no doubts of that. The comps for this latest quarter, they were talking about 11% year-over-year comps for this chain. It's insane. Now, this chain's not a typical restaurant. This is you go up and order, right? And then you either wait for your order, take it to go, or you sit down at a table and they bring it out to you, okay? So picture Chipotle, just higher quality food and takes longer, okay? That's the way I would kind of think about this. Now, in regards to this specific restaurant chain, is about half of the business is to-go business. And so think about how big this one's going to be longer term in regards to, DoorDash and Uber Eats, and once it gets on all the different platforms and things like that, and then all the people that go to the app. Like I tested it last week. I downloaded their app, which got insanely high star reviews on the Apple App Store, right, the iOS store. And I made an order, and boom, walked in, picked up the order. It was very seamless and very easy, and took it back to the house. In this chain, very good quality food and very healthy. And so when we're talking about like people caring more about eating good food, good quality, healthy food, Flower Child's the perfect spot for kind of, in my opinion, the millennial generation, Gen Z, and Gen Alpha over time. So I think Flower Child's in a really great spot. So this is their major growth opportunity. This is, in my opinion, one of the biggest growth opportunities we've seen over the last number of years outside of Chipotle and outside of Cava. I think this is number 3, okay? Next up here, reason number 3 is a minor reason. They have all these other restaurant chains that are basically kind of experimental ones. I've been to many of these because many of them are in Arizona. They're all freaking amazing. They're all amazing, okay? They have 49 of these locations so far, and they did revenue this last fiscal year of $300 million on only 49 restaurants. $300 million. Only 49 restaurants? That's dang impressive, okay? And so those chains are Culinary Dropout, Blanco, the Henry, and those are kind of in that phase where they're testing in different cities, different markets right now to see if they should roll it out national. North Italian Flower Child are going national. They're going to go all over the United States. You're going to see them multiple locations in likely every big city across the United States. Culinary Dropout, Blanco, and the Henry are like testing. Like, let's see what we've got here. Like maybe we are going to go big here, but we got to test it, right? And they have all these other little brands that basically they're seeing like, does that have potential long term? By the way, Olive and Ivy, hidden spot, okay? I shouldn't say hidden. The place is freaking busy all the time. Go there sometime if you're ever in Scottsdale. It's kind of a little more. It's by Fashion Square. They got a phenomenal Olive and Ivy location right on kind of the river there. Oh, it's beautiful. It's beautiful. Very good place. Okay, that's all I'll say about that. So just random little thing there. So accelerating unit growth. I mean, the thing with Cake is they just need as much money as possible because here's the thing, like they're going to be extremely profitable from basically, year one in regards to building out Flower Childs and North Italias and then just continue to get. So the moral of the story is like Cake needs to just focus on building as many North Italias and Flower Childs as they humanly can for the next 10 years. Like year after year after year, just keep up in the locations. They're talking about 25 locations in 2025. I want to see them double it and double it again over the next 2 years. 2026, I want to see 50 locations. 2027, I want to see 100 locations. We've got to really accelerate unit growth for this company because the opportunity is just so big, okay? Now look at the operating income for this company. It's gone beast mode over the trailing 12 months, right? Absolutely phenomenal. I don't see that slowing down. And the great news is the more locations Cake's going to build out here, Flower Childs and North Italias, right? And then their other concepts, the more money the company's going to then have to invest into more locations and more locations and more locations. So, which then helps them make even more money and more money and more money and more locations and more. And because they have so many successful brands, the company's got the next 10 to 20 years on lockdown in regards to growth. Like, Cake's gonna, like, we could be 10 years in the future and we're still going to be talking about Cake's got some other big next growth opportunity that they're going to grow this restaurant chain to 300 restaurants. Like I don't see it stopping anytime soon. And Flower Child, don't be surprised if they end up going 1,000 locations plus long term there. Don't be surprised. They're talking about 700. I wouldn't be surprised if you see 1,000 plus, because that concept, I think they're never going to be able to build out as many as like Chipotle, probably talking 5,000 locations long term in the United States. I don't think they could ever do that sort of number of Flower Childs, but like 1,000, I think it's very doable. So even some of these, even like North Italia, they only got 200 locations there. I could see 300, 400 North Italias in the United States alone, right? And then we talk about international opportunity. Oh my gosh, like, come on, man. Come on. Now, in regards to Cake, company trades silly cheap, forward P of 15 on this company. And we're talking about, this is a company that's set up for massive growth for the next 10 to 20 years. We're not talking the next year. We're not talking about, oh, they just got this one thing. They're going to sell a lot of, AI chips next year. No. We're talking about Cake has massive growth for the next 10 to 20 years, folks. 10 to 20 years. And it's trading at a forward P of 15. Silly. Like, people still don't understand. Like, I think they think of Cake and they think just of the Cheesecake Factory restaurant. And they're like, oh, I don't want to own that. And they don't understand like all these insane growth concepts that are coming behind right now that are going to actually be way bigger than the Cheesecake Factory restaurant concept ever was, right? Now, if you compare this, if we pull up the compare feature on 1000xstocks.com here and compare Cake to, let's say, Texas Roadhouse and Chipotle, my belief is Cake's going to have way better growth rates over the next, decade than Texas Roadhouse and Chipotle. But look at the forward P. Trades at 15 versus Texas Roadhouse is 25 and Chipotle's 44. Silly. So, that's going to be corrected. And the forward P, I think where Cake will be long term is kind of in that 25 to 35 range, in my personal opinion, right? Now, this news here came out very, very recently. Company is going to do a $450 million convertible senior notes that are going to be due in 2030. Cheesecake Factory notes will mature on March 15th, 2030. Usually how these notes work is they can, if the stock price goes up a lot, they can just kind of dilute shareholder value. So they don't have to essentially pay that money out of pocket, essentially. And they can just, basically give shares in the company at that particular time come 2030. And my guess is Cheesecake's going to be a lot higher stock price in 2030. Like, I wouldn't be surprised if Cheesecake was like $100 to $200 a share by March 15th, 2030. Okay. And so, but here's the interesting thing. They announced a 450 and then they upsized it because they had so much demand. And so sometimes when you announce one of these deals, if there's so much demand, you can upsize. That's exactly what they did. They upsized it to $500 million of 2% convertible senior notes due 2030 in a private placement. Guess what? They upsized it again. They got even more money. They issued $575 million of convertible senior notes due 2030. My guess is, you got to understand, people aren't just going to, get these senior notes and put their hard-earned money in for these senior notes unless they are very confident, like Cake has an incredible growth profile the next number of years. So now Cake is going to have massive money behind them that they're going to be able to really invest. Because like I said, 25 restaurants, I know it's going to be like the strongest number Cake's ever done in terms of how many restaurants are opening a year, 25 in 2025, right? I'm just telling you guys, like, this is child's play numbers. Like, I expect the company to open 50 restaurants next year in 2026. I expect them to open 100 restaurants in 2027. Like, we're going to scale this baby. And so in order to scale it and build out a massive amount of Flower Childs and a massive amount of North Italias and then these other concepts, company needs a lot of money, man. You need a lot of money to build out all those locations, right? So the moral of the story is long time of growth ahead, right? And they raise that money. And I think we're looking really, really dang good. Now, additionally, the best thing with Cake, it's one of just many good things with Cake, is I don't have to rush and sell my shares anytime soon. And the reason being is I get paid my dividends. They pay you 27 cents per share you own. of the stock, so I can sit back and just collect my dividend money, go buy more cake shares with that dividend money when it comes in every 3 months, or buy other shares. Honestly, I wouldn't mind if they cut the dividend personally. That's just my thing. Like, I wouldn't mind if they cut the dividend and just invested all the money into the new locations, because the growth opportunities are just so immense for this company in the next 10 years. But I understand, some shareholders like the dividend. So, and I don't mind it. Like, I'm not the biggest in favor of them upping the dividend anytime soon, because I'm like, they need to just grow. And what we're going to see from Cake, in my opinion, is we're going to start to see growth rates that accelerate significantly year after year after year for a long time to go in the future. And that's going to be very, very fun, right? So the moral of the story is, in regards to Cake, bye. Okay. Appreciate y'all joining me as always. If you're looking to apply to our private stock group, private wealth group, get access to 1000xstocks.com, the software I use each and every day. Pin comment down there, click on that, fill out a form, see if we get you access to that here either this week or in the next few weeks. Okay. Much love and have a great day.